Earlier in the chat, you mentioned the possibility of the cycle coming to an end, and everybody stresses about that. Where are we in the cycle, do you think? I mean, do you think it's a matter of time before the cycle ends, or will this be a more elongated cycle? Any thoughts on that?
If you just were to look at fundamentals, then clearly you could see the cycle continuing for a while, easily up to 24 months or so. Because if you look at the data, there's nothing really that would worry us, other than, you know, obviously probably a bit of a normalization towards trend growth. So in terms of consumption, capex spending, this all kind of seems to kind of just trot along quite nicely. And hence it will come down, to my mind, to more kind of external factors that might add to an either deceleration or acceleration. Interestingly, there's two elements. One are the more negative ones around protectionism, potential trade war, which again, from looking at any historic precedent, it's clear that it is growth negative and could clearly add to an acceleration towards the end. Other areas that we're watching, obviously, are the credit cycle, and here particularly in China, because that we should not underestimate how strongly the China credit cycle has actually helped the global growth cycle. And clearly, if we look back to 2017 and the acceleration into the second half of 2017, then you find a very strong correlation with the credit stimulus provided by China. So this is an area we're looking for, because if you look at the global growth dynamic, then China is such a key part. So whatever the policymakers' next steps are in China will have an impact on the global growth dynamic. So that's literally the two areas we're watching very carefully.
But you speak of external triggers. I mean, what worries you most about where something might come out and blindside you? I mean, the trade war is off discussed. It's on the table now. Could it be something in the corporate bond market in the US if yields continue to rise? Could it be an accident in emerging markets like maybe a Turkey or something, defaults on debt? Where is it likely to come from?
You've raised two very important points already, and the corporate bond market, particularly the high yield space, obviously is priced to a default level that is not very realistic with the expectation for the end of the cycle. So you wonder whether, you know, we will see the kind of lead indicator coming from widening spreads, not necessarily across the board to start with, but within the pockets where obviously leverage has been rising the most, and as such we have the highest vulnerability towards higher interest rates and hence higher default rates. It is interesting because in aggregate it still seems okay in the US, but again it probably the aggregate level is not really telling us where the pressure points and the stress points are. And again, it's something we're watching very carefully. So far, again, it's nothing that worries us dramatically. But again, you know, we know that back in 2007, 2008, it was the credit market that was the lead indicator of worse things to come. So we better have learned our lesson and pay attention to what's been happening there. The emerging market bond space is interesting, and obviously Argentina was the one that was in the spotlight more recently. And what I do find very interesting, and that comes back to the point around complacency. If you remember that it's not long ago that they issued their 100-year bond at yield levels that, you know, we even back then wondered whether that really compensates for the risk you're taking. And yet just, you know, a couple of months later, and the government has to call the IMF back in. So, and it shows as well how fickle investor sentiment is, because obviously the sell-off we've seen in the currency and in the bonds has been quite dramatic. Whereas, you know, just a couple of months ago, it seems, you know, we were willing to pay quite healthy prices for a 100-year issuance for a country that has, you know, defaulted on a rather regular basis. Having seen,
I mean, I come back to that original question, having seen so many cycles over the years, what are your thoughts on being able to predict when the slowdown is coming or when the cycle is turning? Does it usually give you so much time and notice to be able to react? Or usually over the last few cycles, we've seen something external precipitating it, and you have to react really quickly?
The difficulty, again, is that we're not quite sure yet where the potential turning point is coming from. And I think what we are trying to do really is just look at the risk framework on how to judge the macroeconomic environment. And the components clearly are that we try to really assess individually macroeconomic data. What's the growth and inflation outlook? Is there anything in the data that worries us that would be a lead indicator to think for things to come? Second is central bank policy liquidity. Again, obviously related to some extent to the earlier point. Is there anything in the data that would change the reaction by function of central banks that obviously then would have implication for markets? Then you add market valuation and sentiment levels. Whether whether your starting point obviously provides you with some margin of safety or not, and clearly this is where some warning signals are, because most asset classes are priced to an extent that there is no margin of safety. And then you add obviously political events to it, because they are the most they're the most difficult to predict, yet can play quite a significant role to determine what then the market implication is of all of these. And for us, it's important to break those down into those four components, because only then you can detect where the sensitivities are, which obviously in combination will have the impact then on markets, on where we're heading. And, warning signs, I think most of them we have highlighted already, what we're watching, and they can be either fundamental indicators or market-related indicators, as I said, within the fixed income market, spread levels widening in some areas, what's the read across. And I guess that really is the only way to be prepared then for potential changes. And as such, we try to apply this framework and be kind of humble enough to make sure that we can look at those data points on a regular basis to make sure that we're aware of any changes that is happening.
But speaking of the cycle, what about the emerging market cycle? Because that's not 8 or 9 years old. I mean, we've had a rough time.
Yeah.
So maybe we are 2 years into that cycle in emerging markets. How do you juxtapose the two? I mean, the developed market cycle versus the emerging market cycle that we're witnessing now?
You're absolutely right. The emerging markets obviously have taken longer to kind of see the recovery really starting across the board, and the adjustment processes did take longer than in the developed world. Yet again, looking at my risk framework, so I think I still can tick the box in terms of the fundamental data, because you're absolutely right that in terms of the growth momentum, emerging markets, particularly ex-China, still look pretty strong and still look to accelerate. Yet I cannot obviously ignore that there is an external influence, not only from central bank policy around the world, but in terms of market valuation and sentiment. And here I think I would include the dollar, because although this has no immediate influence on the fundamentals on the ground, it has an influence on markets. And hence for emerging markets, you always have to balance what's the strength of the fundamental data, and might then even a sell-off, as we're experiencing right now, provide an opportunity to re-engage. So that really, again, same principles. Look at the risk framework, assess them individually to make a case whether, volatility and a market setback provides an opportunity, or whether it should worry us and we disengage. And I think very important for us here is you have to do this for each of the countries individually. They are no longer a very kind of homogeneous group that you should look at as one. You have to look at them individually, and I think the cases around Argentina and Turkey make this very clear, that what is going on there has nothing to do with the emerging market complex. It's a very kind of country by country case, and it's problems that are homemade from these two countries.
Where does India fit into that picture? As you say, I mean, look at it individually. What are your thoughts on where we stand?
India is interesting, because obviously in terms of the growth profile, it definitely ticks the box and looks very positive. And again, obviously the oil price does play a big role for India and the stock market. And I think what we would say in general is that the current backdrop and the increased volatility is a backdrop for active stock selection. And if you look across our emerging market range, then clearly what you are finding is it's much more the stock-specific story that drives the selection rather than the country proposition. Yet we are obviously aware that if you have a country like Argentina, normally it does not pay off to engage even with individual stocks, because the country risk will outweigh the stock-specific opportunities. But for India in particular, it really comes down to the stock-specific areas, and it seems that from a growth angle here, the support of the two components is very attractive.
Sonja, it's been a pleasure. Thank you very much for your time today.
My pleasure.